Hello everyone, welcome to the 17th episode of me learning how to trade using Forex. So in the last video we went through mastering shares and indices intermediate course on Forex.com, and we went through ways to trade shares lesson, and then we're currently now doing how corporate actions affect shares. So let's get started. How corporate actions affect shares. When you trade shares, you'll need to pay attention to the actions of your chosen companies. Sometimes they'll have a direct impact on your open positions. So, when trading shares, attention is needed on the actions of your chosen company. What is a corporate action? A corporate action is an event initiated by a public company that would affect the shares it has issued. A corporate action is an event initiated by a public company that will affect the shares it has issued. There are many different types of corporate action, but traders mainly focus on those that will affect the shares price. Some actions are used to lower a company's stock price, some to raise it. Let's take a look at the main corporate actions you might encounter as you trade shares, plus how they'll affect you if you have an open CFD position on the company. Dividends. We've already encountered the most common corporate action, dividend, used by the companies to reward investors with a share of the business's profits. Dividends will usually cause a stock's price to fall, or it causes it to fall. Dividends usually will cause the stock price to fall. Why? Because the company has just parted with a large pool of cash, making it worth less overall. Oh, right, I see. I thought it would raise its price because if it's paying out cash, then people are more interested in trying to get a hold of that share so that they'll also be paid as well. So it increases the demand, but I guess not. Usually it will cause the stock price to fall, because the company has just parted with a large pool of cash, making it worth less overall. CFD dividends. If you have a long CFD position in a company that pays a dividend, your account will be credited. If you have a short trade, you'll have to pay the dividend. You have to pay the dividend. Oh, right. Just like when investing, the amount you pay or receive will depend on the size of your position, and dividends only apply if you open your trade before the X date. With Forex.com, dividends will be paid or deducted before the market opens on the X date. You'll usually find that the fall in stock's price on the X date will offset the dividend you received or paid. You usually find that the falls in stock's price on the X date will offset the dividend you received or paid. Interesting. So let's delete that. It's not worth it. Rights issues. So, whoops. Rights issues. Rights issues, sometimes called secondary offerings, occur when a company offers new stock to existing shareholders, usually at a discount of their current market price. Also called secondary offerings, occur when a company offers new stock to existing shareholders, usually at a discount to their current market price. Like dividends, rights issues would typically cause a company's share price to fall. Usually cause a company's share price to fall. Here it's because they're diluting the number of shares available to the open market, so increasing the supply. Because they're diluting the number of shares available on the open market, increasing the supply. Rights issues tend to come with a deadline. You'll have to decide whether to take up with the offer before this date. Tends to come with a deadline. Open offers versus rights issues. Like rights issues, in open offers, existing investors are offered the choice to buy more stock. However, you can't sell your rights in an open offer. Can't sell rights in an open offer. Like rights issues, in open offers, existing investors are offered the chance to buy more stock. However, you can't sell your rights in an open offer. Also, you can't sell your stock then, basically. Right, okay. Rights issues and Forex.com. If you have an open CFD position at a company that offers a rights issue, we'll add a new position to your account with a price of 0. What you can do next depends on whether you're long or short on the stock. So whether you're buying or selling. Like rights issues. If you're buying or going long, you can sell the short right issue before the deadline at the market price. Take up the rights. This will result in a new position at the price of the rights issue. If you're short, buy back the rights before the deadline at marketplace. Leave the rights position open after the deadline. You will then automatically open a new short position at the market price. If you're buying, you can sell the rights issue before deadline at the market. Take up the rights. This will result in a new position at the price of the rights issue. If you're selling, buy back the rights. Leave the rights position open after the deadline. You will then automatically open a new short position at the market price. Mergers and acquisitions. Mergers and acquisitions are two ways in which two listed companies can become a single stock. So, the two ways which two listed companies become a single stock. Both can take months or years to finalize and often fail to go through if terms cannot be agreed. During this period, investors and traders will be able to buy and sell both stocks as normal. If the consolidation completes though, one or both of the stocks will cease to exist. What happens next for shareholders is dependent on the terms of the merger or acquisition. Can take a long time. To finalize. If the consolidation completes, one or both of the stocks will cease to exist. One or both of the stocks will cease to exist. Will cease to exist. What happens next for shareholders is dependent on the terms of the merger or acquisition. What happens next to the shareholders is dependent on the terms of the merger or acquisition. CFDs and takeovers. If you have a CFD position on a company that is subjected to a merger or acquisition, then your trade will be closed according to the terms of the deal. We'll then open a new position of the same value after the takeover. Say for instance that you hold 1,000 CFDs in a company A, which is trading at 650 pence. Company A is then bought out by Company B. The terms of the acquisition state that Company A investors will be offered 0.613 shares in B for each share that they own of A. You would receive 613 Company B CFDs because 0.613 times 1,000 is 613. We'll calculate the new price of the CFD to ensure that your trade value remains the same, in this case 6,500, because 650 times 1,000 is 6,500. So, yeah, okay. Stock splits and consolidations. Stock splits and consolidations. Sometimes a company will attempt to control their stock price to prevent it from getting too high or low. Control their stock to prevent it from getting too high or low. Two common methods of achieving this are stock splits and consolidations. Two common methods of achieving this are stock splits and consolidations. In a stock split, the company will give additional shares to all existing shareholders. In stock split, the company will give additional shares to all existing shareholders, A 2-1 split, for instance, means that the number of shares held by each investor is doubled. This should lower the stock's price by increasing the supply. This should lower the stock's price by increasing the supply. A consolidation or reverse stock split does the opposite. Oh, right, okay. A consolidation does the opposite. So that would be dividing or take away shares to all existing shareholders. So like if you got 50 shares, a consolidation then makes it so you have 25 shares, which decreases supply, and if the demand is kept the same, then the stock price will rise. Existing shares are merged to reduce supply in an attempt to increase their price. A reverse split may be a sign that a company is struggling and fears being delisted. CFDs and stock splits. In a stock split, your Forex.com position will be closed, then reopened to reflect the terms of the split. The objective is to reflect the circumstances affecting the share in the public market. In a consolidation, it will compensate you with a cash dividend for any shares that you lose. Right, okay, what moves the prices of the world's biggest indices? Learn what drives the prices of the S&P 500, Dow Jones Industrial Average, FTSE and DAX here. As we covered in the introduction to financial markets, and index price movements are determined by the stock it tracks. Industry news, earnings reports and political announcements will all play out across an index. However, since each benchmark index represents a different group of shares, they each have unique factors to watch out for. Let's explore some key examples. As we covered in indexes, by the stocks it tracks. Since each benchmark index represents a different group of shares, they each have a to watch out for. Let's explore some key examples. S&P 500. The S&P 500 is a gigantic index tracking the 500's largest companies in the world's biggest economy. Big public companies in the world's biggest economy. The total market cap of the stock it follows is over 30 trillion, over 10 times more than the FTSE 100. Jesus. With such wide coverage, No single sector totally dominates the US 500. Although tech has risen to a strong position, whereas tech stocks make up half, half of the Nasdaq 100, however they're just 20 to 30% of the S&P. Instead, most traders see the S&P as a broad metric of the US economy. If the United States is in a period of growth, the S&P usually grows too. In times of recession, it will shrink. Some shares will have an outsized impact on the overall index though, thanks to its capitalization weighted model. The 10 biggest US companies make up around a quarter of its total value. The FAAMG stocks, Facebook, now Meta, Apple, Amazon, Microsoft and Google, listed on as Alphabet, alone are responsible for some of 20% of S&P's movement. Some shares will have an outsized impact on the overall index. Some shares will have an outsized impact on the overall index. Thanks to its capitalization weighted model. The 10 biggest US companies, the 2, 4, 6. The 10. Make up around a quarter of its total value. So despite not being a tech-focused index, anything that will benefit or harm the world's biggest technology companies will likely do the same to the S&P 500. The FAMG stocks, Facebook, Meta now they're called, Apple, Amazon, Microsoft, Google, Alphabet alone are responsible for some 20% of the S&P, for some 20% of the S&P's movement. So despite not being a tech-focused index, anything that will benefit or harm the world's biggest technology companies will likely do the same to the index. Dow Jones. Whoops. The Dow Jones and the S&P 500 both claim to track the performance of the US stock market, but they do so in totally different ways. The Dow follows just 30 companies. Which are picked by hand instead of representing the biggest stock by market cap. Because of this, you'll probably find a number of major US shares missing from the Dow. Plus, the DJIA, or Dow Jones, places more weight on companies with higher share prices. Places more weight on companies with higher share prices. In practice, this means that the likes of United Health Group, Home Depot and Goldman Sachs, who all have high share prices, can together make up more than 20% of the index's weighting. Is that United? Can together make up for more than 20% of the index. Apple, meanwhile, is less than 3%. However, the Dow Jones and the S&P are incredibly closely related. Take a look at the chart below. Historically, there hasn't been much to separate the two indices. Interesting. There's no point me visiting this now. So Dow Jones and S&P are very closely related. Because of this correlation, the factors that move the S&P will tend to have the same effect on the Dow. So because of this, tend to move same effect on Dow. Good news for the US economy, we'll see it rise. Bad news, we'll see it shrink. So there's a drop here. What's that about? FTSE 100. Uh, FTSE 100. The FTSE 100 has traditionally been dominated by three sectors. Uh, Financial services, such as HSBC, Lloyds, and Barclays. Oil and gas, BP, Royal Dutch Shell, consumer goods, Unilever, Diageo, and British American Tobacco. Each of these might comprise around 20% of index total weighting at any time. Each of these. So they make up around 60% then, all three of them, right? So might comprise around 20% of the index's total weighting at any time. So can have a significant impact on its overall price. Perhaps the most significant factor to watch out when you're trading the FTSE 100 though is the price of the pound. Most factor to watch when you're trading the FTSE is the price of the pound. Oops, that's the dollars, pound. GBP and the FTSE 100 have historically shown a strong negative correlation. So one rises, the other one falls. If one falls, the other one rises, and yeah, vice versa. GBP and shown a strong negative correlation when the pound is strong. The FTSE can struggle when the pound is weak. The FTSE might rally. Why? Because the companies on the FTSE 100 are mostly very international facing. Right, okay. because companies on the FTSE are very international facing, whatever that means. Some 70% of their profits come from outside of the UK. Oh right, so they don't really rely on the UK market. Percent of their profits side of the UK. When the pound is weak, these exporting companies make more money in pound terms and the FTSE grows. When the pound is weak, the exporting companies make more money in pound terms and the FTSE grows. So they just, well, not necessarily mirror each other, but mirror, like there was a reflection line here, they would copy exactly opposite of, well, not exactly opposite, but like similarly opposite to one another. So like that bit there, that bit there. After the Brexit vote in 2016, for example, the pound tumbled. That provided a tailwind for the FTSE 100 firms, and the index rallied to new record highs despite the new political uncertainty. So I'm assuming that's that bit here, right? The FTSE 250 on the other hand, what is it? This is FTSE 100, isn't it? Is much more domestically focused. If you're looking to take a position on the strength of the UK economy, 250 might be a better bet. If you're looking to take strength, take a position on the strength of the UK economy, the 250 might be a better bet. DAX, DAX. DAX, despite only representing 30 companies, the DAX is rarely dominated by a single stock or sector. By a single stock or sector. The top industries on the index are materials and financial services. And financial services. A core set of companies have remained on the DAX for several years. As the index celebrated its 30th birthday in 2018, 15 companies have been continually on it since its inception. The DAX's constituents might be stable, but the index itself tends towards volatility. Constituents. The index itself. And like the FTSE, it is mostly home to external-facing businesses. So the strength of the euro can have a major impact on its price. Can have a major impact on its index price. EURGBP is 0.87, 30,000 euros costs £25,000. EURGBP equals 0.9, 30,000 costs £27,000. If the euro is particularly strong against the pound, for instance, so this one, a 30,000 car from a company like Volkswagen would be more expensive to purchase for UK consumers, but still only make 30,000 for Volkswagen. This could lower demand or force VW to reduce the price of its cars, hurting its bottom line. If the euro is particularly strong against the pound, for example, so that's... Oh no, it's that, sorry, that should be strong. Because you're using less GBP to get €1. If the euro is particularly strong against the pound, for instance, a 30,000 car from a company like Volkswagen would be more expensive to purchase for the UK for... Oh no, that's strength, because you need 0.9 of GBP to buy €1, so you would need more GBP to buy €1 than that, so this one is stronger than that one. More expensive purchase for UK consumers, but still only make 30,000 for Volkswagen. This could lower demand or force VW to reduce the price of its cars, hurting its bottom line. Stock index trading strategies. Right, okay. In the final lesson in this course, let's examine which strategies and styles work when trading share indices. So, indices versus other markets. Stock indices don't really work like other financial markets. Indices don't work like other financial markets. Take a look at the chart below, comparing the performance of the S&P 500, Wall Street and the DAX to gold and euro dollar in 2010s. Notice the difference. Gold, euro dollar in the 2010s, so that's blue and that's that and that. Euro, light blue and dark blue, so these two compared with these. Bearing a few notable bear runs, the indices have one clear trajectory up. The currency and commodity, on the other hand, are much more range bound over the period. I see. When you consider what an index is, this fact isn't all that surprising. Indices represents economies which tend to grow, with occasional recessions. In a similar way, indices tend to move up in price with occasional corrections. In the 30 years from 1990 to 2020, for example, the FTSE 100 posted a positive annual return 19 times. The DJIA and DAX did the same 22 times, the S&P 21. 100%. Jesus, that's a big year, that is. Which trading style works on indices? I'm just going to read through all of these and we'll make notes next time, because I don't think we'll have enough time to make notes if we're working through this page, so we're just going to have a quick skim through. Which trading styles work on indices? Despite or perhaps because of their difference to stocks, currencies and commodities, indices are used by traders of pretty much any style. Thanks to their regular returns, they're popular among long-term position traders. Using investments like exchange-traded yield funds, these traders can take a position on an entire index without buying each individual stock. However, like any financial market, an index's price movement is rarely linear. Sellers can step in at any moment, which provides ample oscillations that swings traders can use to drive medium-term profits. A typical swing trade on an index would be to wait for a small retracement after a breakout, then buy before the bull move resumes once more. Alternatively, you could use Bollinger Bands. If your index drops below the lower band into an oversold territory, then it might be about to bounce back, providing a buy opportunity. Short-term day traders and scalpers, meanwhile, often focus on indices. They use the CFDs to take advantage of the high volatility offered by the world's top indices. Again though, most tend to build their strategy around bullish moves. Learn more about trading styles. Shorting and corrections. But what about when the stock index does embark on a bear run? Stock market crashes and index corrections can be a tempting prospect for traders, offering the chance of a big short for big profits. For example, on Black Monday in 1987, the Dow Jones and S&P 500 both shed more than 20% of their total price in a single day. In the 2008 crash, the DJI fell 1,800 points in a week. It went on to drop by 50% in 17 months. In 2020, COVID concerns causes the sharpest crash since 1987. The FTSE fell 10.8% in one session, while the DAX fell by 12.2%. These drops were far sharper than the climbs that preceded them. A corrected timed short position ahead of any of these events would have brought huge profits. So we sold them basically. Traders often say that indices take the escalator on the way up, but the elevator on the way down. Also, it's slower when going up, but when going down, then it's well fast. However, getting that timing perfect is incredibly tricky. Markets can run at irrationally high levels for a long time, and analysts may predict a correction months or even years before it actually arrives. Of course, you can open a short trade and wait for the reversal to arrive, but you would have to make sure that your losses don't see you put on margin call, forcing you to close your position before you see any profit. Predicting the timing of a crash is extremely difficult, but there are tools that traders use to spot one when it is on the way. The volatility index, for instance, uses option prices to measure the market's current fear level. If the VIX is high, then sellers might be about to take over. Alternatively, skyrocketing PE levels are seen by some as an indication of a market bubble that is likely to pop soon, but again, they won't tell you when. Right, okay. Alright, we're going to end it here. In the next video, we're going to start rereading through all this and make some more detailed notes. So, yeah, thank you guys for watching, and I'll see you in the next video. Bye.